Thank you for joining us today. My name is Louis Gutierrez. I am the retiree and emeriti coordinator at UCSF. Dorla Cantu, I'm going to actually ask her to come on, is our program coordinator. Oops, actually, before she comes on, we're going to be taking all questions at the end of the program. So quite a few of you have already submitted questions, and we'll hopefully have those incorporated into the talk. And then if they aren't covered, we'll take questions at the end. And I'm going to have Dorla come on, and she'll go ahead and introduce the speaker. Let's see here.
Morning. Good morning, everyone. Today's speaker, Crystalline Schlegel, is a UC Berkeley grad with her BA in American Studies. She's been in the life insurance industry for 20 years as of this year. Crystalline has a long-term care certification and chartered life underwriter and chartered financial consultant designations from the American College. She specializes in working with small business owners and families. Crystalline attended the Frederick Gunn School in Washington, Connecticut, where she's now on the board of trustees. She enjoys traveling and spending time with family and friends and with her miniature dachshund, Lorenzo. Welcome, Crystalline.
Good morning. Not sure if you guys can hear me okay. Can I get a thumbs up?
We could hear you, but we just
perfect. Okay. There we are. Okay. Good morning, everyone. Well, first of all, thank you very much for having me. It's a pleasure to be here, and a little bit of a role reversal with me being a UC Berkeley student at one point. If any of you were teaching from '96 to 2001, maybe you were my teacher. But anyway, I'm very excited to be here and talk today about the very sexy and exciting topic of long-term care insurance. So as Dorla mentioned, I am a chartered life underwriter, a chartered financial consultant, certified in long-term care, and I actually just recently got my accredited estate planner designation. So I really focus in life, disability, and long-term care insurance. That's what I've been doing for the last 20 years. I was actually kind of raised in the business. My parents both met at Prudential. So some people like to say that it's in my blood. So I kind of know a lot of this stuff from the back of my hand. But today, I'd like to go through kind of a brief overview of the history of long-term care, and then kind of go through what is long-term care, what are the costs associated with it, and then how do we plan to pay for it. And of course, not all of us can qualify for insurance, so I want to make a couple comments about that as well. So the history, and I'm not going to spend a lot of time on this, but it's important to note that long-term care insurance as a product is actually not that old. And when we talk about the insurance industry, because again, being kind of a nerd with this stuff, life insurance actually started in Roman times 5,000 years ago, but long-term care insurance actually only started about 40 years ago. So CNA was the first policy to ever be introduced. It was not sold a lot of, but it was also kind of coupled with Medicare, and it was really based on nursing home only policies. In the 80s is when kind of it really started to be created and rolled out to consumers. And again, it was strictly a nursing home policy. It actually started with Fireman's Fund, which I grew up in Nevada, so it was kind of an interesting tidbit too, because of the Fireman's Fund campus up there, if you're familiar with it. And then American Express actually bought it, and then eventually it was taken over by Genworth, that particular book of business. So if you've heard of long-term care insurance, I'm sure you've heard that Genworth was one of the largest players in this space. So it's kind of interesting that that's where that originated from. In the 90s is when group long-term care insurance kind of came into play with the Fortune 500 companies, and they started providing that to their employees. And it was kind of something that we thought from an industry standpoint would be accepted and actually implemented a lot more than it was, which then ultimately met its demise. It's very difficult to get a group long-term care policy now. We don't really have any options in the state of California anymore, but I think that that's going to come full circle, and we'll start talking about some of this stuff later. In 1995, we had a lot of questions about this. CalPERS started offering long-term care insurance. And I did get a lot of questions about the CalPERS stuff. I'm going to do my best to answer them, but from the perspective that I have been an insurance agent for 20 years and selling individual consumer products, I obviously never had access to being able to sell the CalPERS policy. I've done a number of reviews and looked at those contracts. And when we talk about what's happened in the industry and why CalPERS fell subject to those exact same issues, which was not having really good underwriting, meaning just kind of letting everybody sign up without understanding the risk. Also really pricing their policies very low and not understanding, again, the risk that they were offering to clients, as well as the actual claims experience, which if you offer unlimited benefits and someone has an 8-year cognitive claim, that's obviously a very big dollar amount versus what the actual individual paid into the policy. So that's what happened with a lot of carriers, which is why we're at where we're at today. 1996, we have the first company that starts exiting the business, which was Principal. We then have the long-term care for the group market starts to get, again, mid-90s, starts to kind of explodes. We start offering it to a lot of employers with 100 employees or more. And then in 2000, we have the Security Act and the federal long-term care program, which when I started my career, it was with John Hancock in 2003. And it was a very big program between MetLife and John Hancock. The top 3 carriers were Genworth, MetLife, and John Hancock in terms of selling these policies. And they were very much in the game. In 2002, right before I got into the business, this is really considered the apex of long-term care insurance sales. We had over 100 insurers in the business. Everybody kind of wanted a piece of this market. And unfortunately, everybody was kind of doing the same thing, which was rolling it out to people or to consumers, not really having any underwriting experience or claims paying experience, and also using models of how they created the pricing from like existing life insurance policies. So there's a lapse rate that they build into the pricing of policies, meaning that, there's always going to be so many people that let these policies lapse. While with long-term care, with standalone traditional long-term care policies, the lapse rate on these contracts is actually less than 1%. So all those premium dollars that they thought that they would capture and not have to have any payout for, that's not actually occurring. 2003, CNA, one of the first providers, exits the market as well. The other thing that's very important to know is 2003, one of the first hybrid products comes out by John Hancock, and they are still in this market, and it's definitely where consumers are starting to go, and we'll talk about those products later. 2005, the Deficit Reduction Act, which goes into basically stating that states started to realize that a majority of their aid from their Medicaid programs, or in the state of California, Medi-Cal, was going to pay for long-term care expenses or taking care of the elderly and the care needs. So the DRA was basically a partnership model that allowed people that owned their own private long-term care insurance policy to be able to protect that amount of assets that they had spent down on that policy. So for example, if they had a policy that had $300,000 in benefits and they spent all of that down, they would then be ready to qualify for Medicaid or Medi-Cal because they had impoverished themselves. They could protect whatever the minimum limitations were, plus the $300,000 that they used in their long-term care policy, because the states recognized they wanted to keep people off of this particular program for long-term care for as long as possible because it was significantly impacting the dollars. Pension Protection Act is then put into place in 2006, and we have now tax qualified language that's added to annuities. And that is also something I'll talk about later, which is a really interesting thought in terms of annuities that have gain and being able to use all of those annuities without any taxation if you're using it for a long-term care expense. course, we have the financial crisis and we have low interest rates for an extended period of time. And this starts basically the landslide of carriers that decide that they no longer want to be in this business. It is not going to be profitable. And if anything, it actually may sink them. So we have all these carriers that leave the business. There's no more group plans. And things just really started to change about 12, 15 years ago. Then we have Prudential and Unum, which also a lot of people have Unum group policies. That was a big player. And then, of course, we get into the teens and we have a lot of change happening with only down from 104 to just a short 11 years later, only have 16 remaining insurers. So it was the industry itself has been very volatile in the past. But that being said, we're in a good place now because we have kind of ruled out all the people that don't want to be involved in this game. And not only that, but we have a lot more stability. So in the past, we used to have gender neutral rates. So male or female, the rates were the same. Then they started, figuring out that we have statistical data that shows that men have a much shorter long-term care event than women typically do. And a lot of times the women will take care of the men before they pass. So there's not a lot of claims being activated in that regard, but then the women live longer and then they definitely need care and need care for a longer period of time. So what they decided to do was they were now going to make gender specific premiums. So women are going to be more expensive on standalone policies than men are. John Hancock, as I mentioned, a big player in the market, they exit the traditional standalone market. So that was a big hit in my opinion. However, as I mentioned, they put those hybrid policies back into place in the early 2000s. And that is what most life insurance companies are actually modeling, is the hybrid life insurance policies with the ability to access for long-term care. Now, the big one that I will talk about a little bit later is the Washington state payroll deduction. And don't worry, I'm not going to skip over the 2016 to 2023 CalPERS rate increases because it was more than that. They were increasing rates back in the early teens as well. And so I will touch on that as we go down the slides. But the big one that I think most of us need to really be aware of, especially in the state of California, is the new legislation that is out there in order to provide our consumers with a long-term care policy via a payroll deduction. What that looks like yet, we don't know, but what happened in Washington is something that I hope California does not model. Then, of course, we also had over the last few years, the settlement and the class action lawsuits with Genworth, resulting in rate increases. Okay, so what is long-term care? So by definition, it is a chronic period of time, chronic illness, or it's not talking about acute of like a surgery and recovery and rehab. We're talking about something that is going to last for longer than 180 days. So it's a chronic issue where you're going to need personal care or supervision. And the extended period of time, like I mentioned, is the 180 days. It is, of course, associated with the effects of aging. However, shockingly, 40% of the people in the United States today that receive some form of long-term care are actually under the age of 65. And that's due to either a disability or an illness or an accident. Some of the conditions that may require long-term care are listed here with head injury, stroke, cancer, Parkinson's, Alzheimer's, dementia, or any cognitive impairment, multiple sclerosis, or heart disease. Now, by the facts, as I mentioned before, statistically, the average claim is about 2.5 to 3 years, and men fall on that 2-year line and women fall on the 4-year line. So those are averages. And so when I speak to people about trying to plan for an event, we can always use statistics, right? They're great. But as we know, they're things that are on the outlier of the bell curve, right? So when I say average, imagining my hair on fire and me standing in a bucket of ice. Somewhere in the middle of my stomach, that's an average. So technically, we actually have experienced in this industry claims lasting as long as 16 or 17 years. I believe the longest one is around 17 years and still ongoing. Typically, these are cognitive impairments. So they do happen. And so that's why it's important to look at your own situation when you're planning for this, because maybe 2 years is enough and you're comfortable with that and protecting that risk. Or maybe you want something a little bit more extended because you have some form of cognitive issues hereditary wise with parents or something like that. Most long-term care events begin at home. A lot of people believe that long-term care, the actual act of long-term care, is when someone's in a nursing home, needing standby assistance 24 hours a day. That is not the case. Most long-term care starts in the home, where maybe there's only a need for someone to be there 3 to 4 days a week, making sure that that individual is okay. And, they may have some supervision and needs for, activities of daily living, but maybe there's a caregiver in the home that only needs someone to come for a couple days of the week to relieve that individual. If obviously it's a cognitive issue, then that becomes a little bit different. But again, there's a lot of people that start with their what we call care continuum in the home. For every person that reaches the age of 65, this statistic is what I think a lot of people would like to ignore, but out of every 7 of 10 people that reach the age of 65, they're going to have some form of event, whether that's 6 months or 6 years, then that is statistically the number. If there's a couple reaching the age of 65 together, there's a 91% chance that one of them will have an event. And of course, we don't have a crystal ball, which is why when we're talking to couples, we always want to make sure we're covering both spouses, because we have no idea which one is going to potentially have the event. So now when we talk about the cost of care obviously varies quite a bit, and it also depends on the level of care that you need and the venue of care that you need. And also if you're using a licensed and bonded caregiver. So I'm very aware that there's lots of people out there that have, friends, family members, or potentially some of the underground caregiving networks that will cost a lot less. However, there is no consumer protection in that. And I don't go through these stories, but you can ask me personally the kinds of elder abuse issues that I've seen happen with someone that is, having a caregiver that's unlicensed in the home. But assisted living facilities typically are costing anywhere from $5,000 to $10,000 a month. Plus there may be additional fees on top of that, depending on the level of care. So that's something to keep in mind in terms of assisted living. Home health care, again, anywhere from $32 to $40 an hour. It depends on the level of care needed. So do you need a skilled nurse, or do you need just someone to come in and make sure that your meds are being taken and your food is being prepared and you're able to get, from the bed to the couch or to the kitchen table, or being able to, be bathed and take a shower. So it really just depends on the level of care needed. And then of course, how often you're needing that care, because again, there may be a spouse or a family member that's there, 2 or 3 days a week, and the individual is being cared for by that person as opposed to the actual paid caregiver. And then we have semi-private skilled nursing homes. And this is when I say semi-private, I mean, this is a shared room. So if you were in a private room, it's going to be more expensive. But again, a lot of people don't actually ever make it to a nursing home. There are a lot of times where the care continuum actually ends at home. So there's home health care, and then the individual passes away at home. Or maybe there's home health care and that individual moves to an assisted living facility and receives some services, but does not necessarily end up in a full-blown nursing home with skilled care 24 hours a day. But on average, we're looking at about $130,000 a year. This slide is terrible, and I will admit that, and it's very small to see. So I think that, we're doing not only the recording, but I'm happy to send you guys the slides after. But basically what this is talking about is the cost of care and inflation. And so over the past 20 years, the average cost of care inflation rate has been about 5%. So I typically use that as a conversation when I'm starting to help people plan. You are age X, and what are we potentially looking at as a cost at age Y when claim actually happens? Now, the average claim age for a long-term care event is somewhere between the ages of 78 and 83. However, because I think that Californians are a little bit more healthy, we have access to, a lot more food and other things, exercise. There's just a lot more that I feel like Northern Californians and Californians do that maybe other folks in the country don't do. And these numbers are based on the national average. So I usually push out to age 85 to 90 for an average claim age. So in this graph or this grid, I'm speaking to a 60-year-old, for example, and let's say that we pick an average monthly benefit of $10,000 a month. That's what we're going to plan for, because if we go back to the last slide, you'll see it's 5 to 10,000, potentially more, depending on how we're looking at the level of care that's needed. But that $10,000 a day benefit or cost or need, by the time we're age 85 and the average inflation rate remains the same at 5%, that cost on a monthly basis is now almost close to $34,000 a month or $405,000 a year. So the planning involved, and again, if you look at men having a 2-year claim versus women having a 4-year claim, we're talking about a significant amount of dollars to be able to cover the entire need. And as I talk about this stuff later, you'll learn that I'm not a huge fan of covering the entire need. I'm a fan of hedging the risk and shifting that risk to an insurance company if we can afford to do so, as well as qualify to do so. So now we're going to get into the various types of coverage. And I'm not going to go down the rabbit hole with all of this because it honestly is really dependent upon the individual situation. I can have the exact set of same assets, same circumstances, same 2 individuals, same age, and their risk propensity could be completely different. So I'm very much into finding out what the individual's situation is. Not only that, but they're also personal view and how we work with behavioral finance. Does this person believe that they are one of the 3 of the 10 that are not going to have an event? That's another part of the insurance conversation. And so I'm going to do this from a 30,000 foot level and know that there should be agents out there other than myself that can help you kind of determine, if you're looking into these products, which is going to be best for your particular situation. So most of the time when we've heard about long-term care insurance, we've always been kind of referencing what we call standalone policies. So I want you to think of a standalone policy as, I have an auto policy, I have a homeowner's policy, and I have a long-term care policy. So I have to have a claim for long-term care to use that policy benefits in any way. There's nothing else that it's really good for. There's no, I'm going to pay into it for 10 years and then I'm going to, call up and cancel the policy and get my cash back. They keep all of that. So you have to use it or lose it. Now, that being said, when we talk about, again, statistics in terms of that, when we look at the odds of you actually being in a total car accident, it's, I believe, something like, now I'm losing the number in my mind, but it's much higher in terms of the actual probability of that happening than a long-term care event. A long-term care event is much more likely to happen, 1 in 4, than it would be, or the 7 in 10 example, than having a total loss of your vehicle or a total loss of your home. So when people say that it's expensive, to me, when you look at the relative benefits, I'm thinking about it as writing a small check, maybe the cost of what the care is today, monthly, on an annual basis, to protect myself by the tenfold down the line. So that's something that, I always try and point out when we're talking about the costs associated with long-term care insurance, because the risk is so high that you are going to use it. So again, traditional long-term care policies, think of them as standalone. They individually insure each person. They're flexible and they're cost efficient, but they also are subject to price hikes, which again, we've covered a couple of times with not only the Genworth lawsuit, as well as CalPERS. And I guess I'll touch a little bit on that now. one of the biggest issues with the CalPERS program, aside from not really paying attention to the risk that they were putting themselves at with providing these policies to anyone who signed up with pre-existing conditions, whatever the case may be, as well as the amount of benefits and inflation that they were offering on them as well. They are not regulated. So when an insurance company wants to sell a product in the state of California or any state, the insurance commissioner approves that product. And there are a lot of protections in play for the consumer in that regard. So if a long-term care insurance company or life insurance company typically that sells long-term care insurance wants to do a rate increase for an entire class of policyholders, they have to apply for that. They also have to prove why they need the extra dollars. And they're also limited to the amount that they can actually hike the premium. So with the CalPERS program, since it was a government program, they weren't really limited to how much they could actually increase the premiums. So I've seen premium increases of 80%, 100%, and in most of the cases that I've reviewed contracts, I've still told people to stay with the policy because, kind of like Social Security, and maybe some of you have a different opinion about this, I don't feel like it's ever going to fail. I feel like they will always step in and make it work somehow, which is, in the case of CalPERS, the same kind of thing. It's too big of an operation for them to basically say, I'm sorry, but we can't afford to pay any of your benefits. I still think that they are valid policies as much as those premiums have been increasing. The recent lawsuit, and as you saw, they tried to go out to insurance companies and see if they could replace these policies with a carrier to handle that risk, and there were no takers. So that is not a good sign. But again, I truly believe that because of the size of the program and who is involved in the program, folks like yourself and law enforcement and a few other people that, they definitely don't want to let down. I don't think that program will entirely implode. They have, in fact, stopped selling the long-term care insurance policies as of 2020. So maybe they can stop the bleeding a little bit at that point. So again, possible solutions, traditional long-term care insurance. We only have a handful of companies in the state of California that even offer these policies anymore, because most of the companies are now going to, if I drop down to the third one, life insurance policies. So they are permanent life insurance policies that are meant to stay in force all the way to life expectancy, whether that's, they'll pay in year 3 or they'll pay in year 33. It's meant to pay the death benefit. However, if you need care and you qualify for care, and again, all the language on all of these policies that have any kind of chronic illness or long-term care rider, that's all, but all the language is exactly the same. So needing standby assistance with 2 out of the 6 activities of daily living, which are bathing, eating, dressing, toileting, transferring, and continence, or a cognitive impairment. And so if you need to use your life insurance policy for a living benefit to protect your assets from a long-term care event or spending down, then you can do that. And most consumers are going this route because they like the fact that, how many insurance policies do you know are guaranteed? Not a whole lot of them, but I can guarantee that you're going to die. I just don't know when, and I don't know how sick you're going to be before it. So if a consumer understands that the investment into that life insurance policy has the ability to not only benefit them from a living benefit while they're alive, or their beneficiaries, their spouses, their charities, their children, then maybe it's something worth investing in. So that is why a lot of the life insurance companies have now started offering products with these long-term care or chronic illness riders. The one in the middle is a little bit different. It also is on a life insurance chassis. However, the life insurance benefit is not going to be as large as, maybe an individual policy like number 3. However, it has the ability to extend those benefits beyond the death benefit. So let me give you a quick example. Number 2, linked benefit. We also actually usually do these as single premiums. We might create a death benefit of $300,000. However, we have $600,000 for long-term care. So once I spend the 300,000, there's no longer a death benefit, but my policy will extend for another 300,000 or possibly unlimited. The number three, whatever, if I buy a pool of money for 300,000 or a death benefit of 300,000, that's it. Once I spend down that death benefit, or either for long-term care or withdraw it for whatever other reasons using cash value, then that is the amount that you get. There is no extension of the long-term care. So again, I'm not going to go down the rabbit hole of all of these because they all work very differently. I actually kind of compare them to fruit. I actually usually say that standalone is an apple and linked benefit is an orange, and life insurance with a long-term care rider is a pear. They all are great, but they all have cons as well. So it's definitely depends on the individual situation at hand. This is another slide that probably is pretty small for everyone to see, but it kind of talks about the pros and cons of my apple, orange, and pear. So it talks about that standalone traditional long-term care insurance, and does it have a death benefit? Does it have cash value? It does not. Life insurance with a long-term care rider has a little bit more flexibility, kind of can be used in multiple purposes as to opposed to just having a long-term care need. And then the asset-based combination product has a little bit more unique ways to fund it. So we actually have the ability to use qualified funds to fund these kinds of programs. And that works well for folks that have kind of a very large retirement account that maybe they don't need or maybe don't plan on using, and therefore they can use assets in their qualified fund to fund their long-term care. And it's usually much more tax advantage than having to take it out of the qualified plan to begin with and then pay income tax. So again, it gets into everyone's individual situation. This also is another slide that has great takeaways. It again talks about the standalone, the asset-based, and then your life insurance. And then lastly, the two other options, because again, understanding what long-term care is and the risk to your retirement is part one. Understanding how you're going to fund it is part two. And there's any combination of ways. There's self-insuring, right? So you just take on all the risk and hope that it's not too much. There's also annuities, as I mentioned before, annuities that are tax qualified after the Pension Protection Act that basically say any gain in that policy that you use or annuity contract that you use for long-term care expenses is not going to be taxed, which is great because if you have an existing annuity that maybe you put $50,000 into it and it's worth $100,000 now, and maybe you're not really sure if you're going to use that for retirement, maybe we reposition that, and instead of annuitizing that first annuity for long-term care and being taxed on the 50 cents every time I take $1 out, we're going to move it to another annuity. And now every dollar that I take out for long-term care is actually income tax free. So basically you just turned your money, doubled it, right? So you got that extra added tax benefit, and it can be very beneficial. So annuities also are really helpful with individuals that can't qualify, that maybe have some potential health issues or pre-existing conditions that preclude them from getting insurance. And then, of course, the other three options that I had talked about. So let's talk about a couple case studies, and because everybody always asks, well, so how much does it cost? So I realized today I'm talking with some folks that are probably beyond the age of 55, but there was a question that asked, when is the best time to buy long-term care insurance? And when I got into the business 20 years ago, most people were looking at these policies in their early 60s. And now that age has come down by about a decade. I even actually have kids, I'm a kid, in their 40s that are actually looking into long-term care insurance. So this particular slide kind of shows an average age of 55. If we're looking at a standalone policy, we are looking at maybe spending $3,000 to $6,000 per year. Again, it depends on gender. It also depends on what kind of benefits we're purchasing. But in this case, I was looking at somewhere around a $7,000 to $10,000 a month benefit. And then over time, with traditional standalone policies, we always have some form of an inflationary component. So it's hopefully keeping up with the pace of the cost of care as it goes up. The life insurance policy with the long-term care rider, again, if I assume I'm going to buy a death benefit of $500,000, age 55, depending on carrier and gender and underwriting class, then that is cost on an annual basis is going to be around $5,000 to $7,000 per year. However, the difference is that there is no inflation. So when we go back to that slide of showing you, okay, if I'm a 60-year-old at age 85, I'm going to need $34,000 a month, or I should be thinking about that kind of number. I work into it backwards. So in this case, with the 500,000, we actually we're eligible to accelerate the life insurance on a monthly basis at up to 4% of the face amount. So in this example with the 500,000, 4% of 500,000 is 20,000 a month. And that remains level. So although if someone went on claim tomorrow, 20,000 a month is going to be most likely in excess of what the cost of care is. However, in 25 years, it's probably going to be less than what the cost of care is. So just understanding that risk, do we buy $1 million at that point, and then you get up to 40,000 and that would cover the entire risk. It's all about the client situation and also affordability as well. But again, I am all for the hedging of the risk as opposed to completely covering the risk. Lastly, the asset-based policies, as I mentioned, are typically done with a single premium. So maybe folks have money in a CD that's kind of earmarked for an emergency fund or the long-term care fund, and you're not really earning very much interest. We actually can take that money and turn it into something that could be 2 or 3 times leveraged that amount that provides a death benefit and provides tax-free long-term care insurance or benefits. And that's the other thing that I actually have not talked about, but all of the benefits that come out of any one of these policies are all tax-free. And why that's important is because a lot of times, like I mentioned before with the qualified funds, I may encourage people to take dollars out of their qualified plans, pay the tax, and then buy insurance because the leverage is so much greater. And if someone needs care down the line, maybe they can get a better rate of return, assuming that they don't have an event for 20 or 30 years. However, when you go to take that money out, if it's costing $10,000 a month, it's actually costing a lot more, depending on what income tax bracket you're in. So that's always something to keep in mind as well. Another quick question that was in here, the applicability of long-term care insurance to assisted senior living communities, as well as SNFs or skilled nursing facilities. Understand that all of these products now have definitely evolved, right? So if you recall, I said that they all started with nursing home only. All of these policies provide benefits for home health care, adult daycare, assisted living, skilled nursing, the CCRCs, and basically any place that you can actually receive a qualified licensed caregiving service is where those benefits will be applied to. Okay, so these were just a couple of things to note as I wrap up the conversation. The definition of long-term care, like as I mentioned, is a chronic ongoing condition lasting longer than 6 months. So don't think of these policies as an extension of your Medicare. Medicare is your, health insurance past 65 plus your medical supplements. Those are the ones that the surgeries, the rehabilitation, that's all going to be covered by Medicare. Of course, Medicare will pay for long-term care services up to the first 100 days, assuming that there has been a couple of other events that occurred, which is, making the lovely trip to the hospital and spending, I think it's 3 days in the hospital and needing some form of rehabilitation. Again, Medicare is going to cover that first 100 days, which is why most of the insurance products actually have what's called a waiting period. And that waiting period, I kind of correlate to a medical insurance deductible. So how much we're going to come out of pocket before the benefits kick in. And most all of these waiting periods within these policies on average are 90 days or 100 days. And the reason why that was set that way is because your Medicare will most likely pay for the first 100 days of care that's needed. So just remember, think of long-term care insurance as that long-term event of longer than 6 months. Traditional long-term care insurance, as I mentioned, women now are more expensive than men versus them being the exact same cost before. But if we go the opposite route, as I mentioned, men usually pass away before women. If we're talking about life insurance as the product, the life insurance is going to be more expensive on the men than it is for the women. So it's kind of a flip-flop. The average claim is about 2.5 years. I personally think that typically when I'm doing my planning, I account for 3 years because it's kind of right down the middle between the 2 and the 4 years between men and women. And again, there's only a handful of companies that are offering traditional long-term care in the state of California. There's only a few that I actually will work with, only because they're cheap. And so my concern there is if they're cheap, they're possibly not pricing their products right. And that's the last thing I want for my clients is in 10 to 15 years, them getting a huge premium increase. So I have luckily in 20 years been able to avoid that with most of my clients. I personally bought a John Hancock long-term care insurance policy when I was 25. And yes, I know people are like, why would you buy that? Well, I used to be an avid snowboarder and well, I still am, but I used to be a little bit more daring. And my concern is if I hit that tree and it didn't kill me, right? So I didn't want my parents taking care of me. So I did purchase a policy 20 years ago. And I've only had one premium increase, but I have had it happen and it wasn't significant enough for me to drop my policy. And I know my benefits over the last 20 years have inflated so much, it has been so worth keeping that contract. And back to what I was talking about, the instability in the market 20 years ago or over the last 10, we've really had some, like, I kind of want to say we kind of shook out the ones that weren't going to be involved in this space. And so even though there's some carriers I won't sell, there are some carriers that are really stable and I believe in. More and more companies are moving to the hybrid and the combo policies. They've been around for a while, but again, they're starting to see that consumers are really actually kind of hooking on to these and liking these much better. And also you have to understand that from a life insurance perspective, we've had data on those types of policies and life expectancy for a long time. So the pricing on those policies can be guaranteed and you could not be subject to any premium increases. So that's also something that a lot of consumers like. For the uninsurable, there are the annuity options that provide the tax benefits, as well as some additional leverage for long-term care. So, if we're not experiencing much medical issues, and we're not there needing the care yet, we can actually add a little buffer, a little rider onto these annuity benefits as well. And then lastly, the California legislation on long-term care programs are coming. So I'm not sure how many of you are familiar with the Washington CARES Act or the Long-Term Care Trust Act, but basically what the state of Washington decided to do was mandate a payroll premium. And it's about $600 a year for every $100,000, which does not sound like that much. However, the amount of benefits that they're providing is very, very limited. If we talk about what I just mentioned in terms of the average cost of care, Washington isn't that far behind California in terms of cost. And the benefit pool that you are receiving by paying into this particular payroll premium is only $36,500. So it's roughly $100 a day. Now, the cost of care is definitely more expensive than that. So what I don't like about this plan is, unfortunately, it's giving people a false sense of security that they have some long-term care insurance in play. Not only that, all my friends in Spokane, if they decide just to move over to Coeur d'Alene, their benefits are gone. They don't get to use them. You have to stay in the state of Washington. Whereas if you're buying a private insurance policy, that policy goes with you everywhere, including internationally. So we don't know what's happening, particularly with the California program. This legislation came about, I want to say about 12 months ago or so, but this year in 2023, they've appointed, actuaries and a bunch of folks to be on this task force. It's kind of hush hush. There's a number of different proposals that are out there. They are doing all the feasibility studies this year, and potentially we may have legislation roll out in 2024, whereas in 2025, we have to start paying into a payroll tax. Now, one of the things that people could do in Washington was opt out of the payroll tax if they could provide information that they had their own private insurance or a form of long-term care insurance. Now, what ended up happening was it became a fire sale in the state of Washington. And by August of 2022, when the payroll tax was supposed to be implemented in 2023, and you were supposed to have your benefit declaration and sent into the state by November 1st, all the carriers stopped selling insurance in the state of Washington. They were absolutely inundated with people trying to buy their own. So my message basically is, if you are going to look into this stuff and you do want to know more information, start to do it sooner than later, only because I feel like these changes are definitely coming and we don't know what it's going to look like. And I don't feel like it's a very robust offering. And so, as I mentioned, it kind of gives consumers a false sense of security that they have, a great long-term care policy, when in fact it's very, very limited. So keep that in mind. I think that is it. So I'm happy to open it up to questions. I know that was a lot of information in a short period of time. So hopefully I answered some of your questions that you sent in. The one thing that I didn't talk about, which I actually mentioned in the original description of the talk, was the Secure 2.0 and its benefits with long-term care. So if you're under 59 and a half, and again, there's not a lot of people probably on this that are, but you actually can take out up to $2,500 a year. You're still subject to the ordinary income tax, but you would not be penalized the 10% to purchase long-term care insurance. So again, I think a lot of, the government is really starting to notice that this is a serious problem and that they're trying to incentivize people to, take things into their own hands, basically. So I'm ready for questions.
Great.
If you've got some.
Yes. Thank you, Crystal. That was again a lot of information, and we will have the video available later. So I'm just going to go through the questions. So I have an individual that is in a continuing life community, and there is a facility next door for assisted living. Do they still have long-term care policy, or do they still need to have long-term care policy?
Well, I think that depends on your cost. I mean, if you moved into the continuing care community, knowing that this was going to be your cost as the care, is needed and things like that, then you've kind of done what's called self-insuring. You certainly, I actually had this question yesterday, you certainly can use your long-term care policy if you have that. Once you're qualified for claim, there should be some form of benefit being kicked out from that policy. If you had an existing contract and are in one of these communities, there should be a way for them to break out the actual cost of care or whatever the monthly fee is. And then the company would be reimbursing the community care place from that amount, whatever that's determined, because there's got to be a breakdown of what housing is, what food is, all those things.
Next question. Well, it's not really a question, but let's see. I took the cash takeaway in the Genworth case, but am now not sure how much coverage I still have.
If you took the cash settlement, you, from what I understood, gave up your policy, unless there was a option of a cash settlement plus, because there was actually, I reviewed several of these, and believe it or not, there was several different ways in terms of which class of policyholders you were in. But if you took a cash settlement and then still have an existing policy, what you can do is you can contact Genworth and ask them for what your benefits are. So what your monthly benefit is, or daily benefit, and then you can calculate your monthly, and then how much of a pool of money you have, and if that's still inflating or if the inflation rider was actually taken off, because that was another one of the options that you could do. But from what I saw, if you took the actual cash settlement, then you were actually giving up your long-term care insurance policy.
Okay. Are insurance agents compensated in a way that may incentivize them to give bad advice? Who should I consult to review alternative policies?
Well, I would say absolutely yes. As you know, the insurance industry is full of shysters. Unfortunately, it is how we get paid. We get paid by commission. I can tell you exactly how we get paid in terms of, like, let's look at these case studies. So I typically, if I'm selling a traditional long-term care insurance policy, I'm going to make anywhere from 50 to 60% of that premium one time, and maybe, depending on the company, a 10% over the next maybe 9 years. And again, I think they've changed a lot of this, so it could be less. I personally actually don't look at my commissions. I make what I make. So I'm not incentivized, but yes, there are certainly people that are. But so between, let's say the premium was 5,000 and I was going to make 60% of that, I would make a $3,000 commission for selling that particular policy. Life insurance with a long-term care rider, let's use that same premium of 5,000. Depending on the carrier, I make anywhere from 85 to 105% of the premium the first year, and then I make nothing after that, maybe 1%. So of the 5,000, I would make somewhere around whatever 85% of 5,000 is, or let's say close to 90%. So roughly more obviously than the traditional, right? And then the asset-based policies, that is a percentage of how much typically the single premium is. So a lot of clients that I work with are writing a check for $100,000. I make 8% of that. So I make $8,000 on that kind of policy. So obviously it runs the gamut, but it also depends on what's right for the client. And we go through this whole process of discovery and finding out who they are, what kind of assets they have, what their health situation is, as well as what they feel about risk. And then we go through an education standpoint of how all these products work and what are the pros and cons. And then they make the decision on what makes sense to them. Again, I don't typically look at commissions, but absolutely there are people that will sell away from one product or another based on the, how much money they're going to make. That's an easy answer I can give you because I've been in this business a long time.
Right. Thank you for that. How does all of this apply to someone who is 80? I have CalPERS without inflation.
Inflation. Okay.
Inflation.
So first of all, we can issue policies both on the life insurance side and the long-term care side. I believe that may have changed, but definitely the asset-based all the way up to age 80. So if someone is healthy, you do have to realize, because we're so close to potential claim age, that those premiums on those policies are going to be very, very expensive. So one, there has to be health and ability to get the insurance. And two, there of course has to be the affordability of not much of the leverage. And that's why when you ask the question of when should people be looking at this, 60s, 70s are still getting into pricey stuff, but 50s is when most people are starting to look at that. So my advice to you is to make sure you find out what your benefits are, make sure your loved ones know what your benefits are and they're aware that this policy exists, and have that somewhere or share with them. And then potentially, if you're concerned about the costs and the inflation and not having it on that policy versus, what the cost may be versus what your benefits are, if you have the ability to, you might want to start a side fund or potentially invest in one of the annuities that has the tax advantaged ability to be used for long-term care.
Okay. Do any LTC policies not have premium increases or prescribed limits on increase amounts?
So there are limits on the increased amounts. Like I said, they can only increase, technically they can only increase the premiums by 30% every 3 years. That's at least used to be the law. As far as, are there any insurance companies out there at all that have ever not had a premium increase? I don't know the answer to that. Part of the other problem is if you recall, I said there were 100 insurers and then there were 16 insurers and now there's less than that. What happened to all those people with policies that those carriers don't want those policies anymore? They sold that book of business. So what they did is they recognized that they could not afford to pay the risk. Then they sold it to another company. Genworth bought a lot of these policies, like Travelers. I'm not sure who bought the Bankers policies, but they had to increase premiums on folks because of the fact that they were just never priced right to begin with. So to answer your question, I don't know if there's any carrier that's never had a premium increase, but I do know that, like I said, my policy that I've had in force since 2003 has only had one premium increase, and it's been kind of negligent. But again, I'm kind of the outlier because I bought a policy when I was 25 years old.
So back to the traditional LTC plan, if it does have inflation adjustments and no lifetime cap, is it worth looking at another option?
No lifetime cap on the inflation or on the actual
The
benefits?
the plan has inflation adjustment and no lifetime cap.
Then I would hold on to that policy for dear life because it don't exist anymore.
Oh, okay. Let's see here. So may I assume the cost for hybrid insurance products that would be very high for someone in their late 70s in age? Can you give an estimate of cost?
I can't give an estimate because it really just depends on, like I said, gender and underwriting and what class we fall into. I certainly have sold insurance to 70-year-olds. That leverage is, again, you need to be in good health for me to recommend that. Otherwise, I just don't think it's a good use of your funds. It's gonna, unless, because that's the thing, right? If you're qualifying for the insurance, then they assume that your life expectancy is going to be a certain period of time. The only way you win, which I don't really think you're winning, is if you pass away sooner than what they think you're going to. And so you may be better off just taking investments and trying to get a decent return. But again, there's tax advantages to life insurance. I'm not trying to steer you away. It just really depends on the situation and the resources behind it.
Right. And then what happens if your LTC benefits run out?
Okay, so if you have a private insurance plan, traditional standalone policy, and there's a couple of different things. So the state of California has what's called the partnership program. And those policies were sold by Genworth, MetLife, John Hancock, Mass Mutual, I believe. And there were a few carriers out there that had that. And so if you have a partnership plan, not only did it actually have more protection in place than a regular policy in terms of premium increases and things like that, it also actually protected you in terms of what you could buy. So they required you to have inflation on it. You couldn't actually buy a policy without it. If you have a partnership plan and let's say you use $500,000 in benefits and the policy is exhausted and you still need care. One, you have to self-fund until you are impoverished, until that you are limited and lowered, your assets are lowered to the limit of Medi-Cal. And I cannot recall what the amount is in terms of assets being able to be retained right now, but it used to be around $120,000. It also used to be, that's what the community spouse could keep. They could keep only $2,000 a month in income. You get to keep the house and the car and the wedding ring. But other than that, you do have to be pretty impoverished to qualify for Medi-Cal. So you would come out of pocket until all of your assets were gone, and then you would apply for Medi-Cal and hopefully be available for the benefits. There's also elder care planning. So if you shift assets out of your estate, the California does a 30-month look back period. So meaning that you want to purposely impoverish yourself. You need to do it more than 3 years in advance of actually needing the care, because they will claw those assets back into your estate and use it as far as a calculation of how many months you have to be on your own before they will actually start paying benefits. It's an interesting calculation, but there are plenty of elder care attorneys actually that will help you plan for basically impoverishing yourself to use Medi-Cal. But if you don't have a partnership plan, one more thing, if you don't have a partnership plan, those assets are not protected over and above the Medi-Cal requirements.
I see. And you have talked about an insurable, but what might disqualify a person from securing LTC insurance?
So any kind of pre-existing conditions with any kind of cognitive impairment. Okay, so if there's any memory issues or things like that going on, that's going to be an automatic decline. Also, any kind of issues, and you have to think of long-term care being something that's not affecting life expectancy, it's affecting your mobility and your ability to take care of yourself. So if we're talking about things like MS, Parkinson's, any kind of potentially autoimmune disorders that may, become issues later on in life. Diabetes is also difficult. So there's a number of things, but typically, again, part of that conversation is kind of a pre-qualification of, do we have any medical concerns? And are those things that can be underwritten, and possibly you might be paying a little bit more. But as you can understand, if there is a fire in the corner, we can't get the insurance. So it really depends. But think about ailments that potentially are going to be issues later on down the line. So knee issues, back issues, things that have not been quote unquote taken care of and are problematic as we speak.
Okay, and then what is the minimum age for qualifying for LTC? And then also benefits of buying before 59 and a half.
So as far as the minimum age, I think I mentioned that, 40% of people receiving long-term care are actually under the age of 65. So I could be, like I said, I could hit that tree and it not kill me, and now I need care. I am 44, I'll be 45 next month. I can receive care as long as I have a policy. So if I qualify for claim and I have a head injury and I no longer am cognitively capable of taking care of myself, then I can receive benefits anytime I want. So once you pay that first premium on any of those policies, you are covered. Obviously, you can't get the policy if they think that you're going to have a claim soon, but that doesn't mean that doesn't necessarily happen to some of us. So you are covered the day that the policy is put in force. As far as buying under 59 and a half, there are a number of reasons, most of all cost. So the younger you are when you start to look at this stuff and purchase it, the less expensive it's going to be, but it also is going to be predicated upon the health issues. So as we all know, 50s, 60s is when we start to have health issues pop up here and there. So your ability to get underwritten and qualify for the insurance is going to be much higher than it would be the longer you wait.
Okay. What is the best way to find a good broker?
Well, me, of course. Actually, I really don't want all 200 of you to help me. I think that what I would be looking for is not someone who only offers standalone insurance, because they may not be versed in the other products that are out there. As mentioned, I specifically focus on life, disability, and long-term care insurance. So I'm very well versed in all the products that are out there. And that was one of the things, actually, when I started my career with John Hancock, we were offering both long-term care insurance and this new type of life insurance with a long-term care rider on it. And I thought it was the coolest thing, because most people were like, I just need term insurance and I just need long-term care. However, when I started to look and do analysis of the cost of both, and then potentially outliving the term, which 98% of the time people do, versus also not having a really, a high probability, but not a 100% guarantee that I was going to use the long-term care, I thought to myself, well, why wouldn't I buy a permanent life insurance policy that has the long-term care rider? That way, if I die prematurely, someone gets the benefit. If I lived a life expectancy and never have a long-term care event, the benefit comes back to my family. If I do have a long-term care event, I can use it and protect my assets. And oh, by the way, if I want to quit entirely altogether and walk away, there's a cash value component of permanent life insurance. So for me, I have been going that direction with consumers for a long time. But I also realize that not everyone loves life insurance or wants to have life insurance. So it depends. The other thing that also, probably isn't pertinent to folks here, but a lot of the traditional policies have tax benefits for business owners. So being able to write off 100% of the premium, maybe that's a better option than the life insurance, of which you cannot deduct. So there's all kinds of ways to talk about these things. And so I guess my point is, in terms of finding the right broker, you want to have somebody that's well-versed in all of these different options versus just trying to talk to you about standalone long-term care insurance.
Okay, we are going to do just a couple of more questions, and then we have to call it quits for the day. So unfortunately, I'm not going to get to everyone, but I'll try to send these to Crystal Ann, and maybe she could provide some response to some of these. Yeah. So I'm going to combine these next two. So are there any policies where the contract includes insurance against the provider dropping the product or going out of business? And then what happens to policyholders when the insurer exits, both for those already drawing benefits and those who hadn't?
Yeah. So again, back to the insurance industry being very highly regulated. If a carrier stops selling policies, those policies still exist that have already been sold. So they have kind of a promise to deliver on that. And as far as the creditworthiness of a company, that's why I use highly rated companies that have significant reserves, some companies that have significant underwriting history and claims paying ability. There is no insurance against a company failing, kind of like, anything over $250,000 in a bank right now. So you want to make sure you're going with a reputable carrier for sure, but that doesn't mean that there's not going to be consolidation of the market, meaning that insurance companies join together. However, the benefits themselves in terms of what's being paid out, if a company becomes insolvent, typically an insurance commissioner of that state will step in and say, okay, Genworth can't pay its benefits, which I don't mean to be using Genworth, don't quote me on that, but Genworth can't pay its benefits. Now, John Hancock and Nationwide and whoever else that was in the long-term care space or understands it is now going to be responsible for that. And they take on that, what we call book of business. So in the history of life insurance, there has never not been a death benefit paid. So the cash value, as I mentioned earlier, that component could be at credit risk. But the death benefit itself, the industry has always upheld companies that have become insolvent by splitting up the risk to other insurance carriers. Just to note, there's over $4 billion in long-term care benefits being paid out on an annual basis. So it's not like these companies are small. They're big companies. And I don't know if that puts anybody at ease or makes it work.
And then can you provide additional resources to further educate individuals on LTC?
Yeah, so for the cost of care, there's a couple of great websites. So Genworth does an annual long-term care cost of care study. And I think they have a map that you can kind of click around and you can find. So, because that's the other thing too, is what if people move out of state? So today I touched on all the stuff in California, the cost of care in Connecticut, twice as expensive. The cost of care in Missouri, 1/3 the cost. So if you're thinking about moving to another state, you also want to include these different numbers in your planning for retirement. So the Genworth cost of care study, you can easily Google this. The other thing is One America. And again, that's 2 words, One America. You can also look up that carrier. They do a lot of the asset-based product that I was talking about. And they have, I believe if you go to the right side of their screen, you can scroll down and it says it's got a little cost of care map. And that's actually a really cool one too, because it's got the ability to inflate. So you can see the prices of 2023 in various areas in all the states. And then you can say, okay, well, what would it cost in 2033 or 2043? And so that also gives you a great idea. There's a lot of resources on those websites. The HICAP office, health insurance, consumer something, can't remember what it is. The HICAP office in California, that also offers a lot of information, as well as the California Partnership for Long-Term Care. So that was the official website for the partnership policies that were being sold in California in regards to that asset protection above and beyond the Medi-Cal limits. So those are probably 4 websites that you can really glean a lot of information about the cost, about different types of policies, and any additional information that you might need.
Awesome. Well, I think that you have definitely overstayed you've actually gone over what we expected. So thank you so much for all of the information. I'm gonna have Dorla come back on and we will again have the recording available, hopefully.
You muted yourself.
I muted myself.
Okay.
Trying to do too many things here. Well, thank you again, and then thank you everyone who attended today, and we hope to see you guys again soon.
Yes, thank you very much for the
Yeah.
opportunity. I really
Yeah,
appreciate it.
awesome.
And I was just trying to spew out enough information like all these faculty used to do and just confuse us.
No, it was all really wonderful. So
Yeah,
thank you.
Thank you. I appreciate it.
Thanks very much.
Bye-bye. Bye, everyone.